One of the most popular investment strategies, the three-fund strategy, is killing your portfolio returns. I'm going to talk about three popular Vanguard ETFs that are used for this three-fund strategy and why long-term investors should completely avoid these funds. And here it is right here, three-fund portfolio, how to save for retirement with just three investments. A three-fund portfolio is a simple yet smart way to create a diversified retirement savings plan by focus on stocks, one U.S. fund, one international, and bonds with one U.S. bond fund. Why that ratio? Over the time, stocks have delivered better returns than high-quality bonds and cash. The annualized return for large U.S. stocks dating back to 1928 is around 8.5%. Meanwhile, bonds like 10-year U.S. Treasury notes, for instance, have provided inflation-adjusted annualized return of 2.3%. And that's the key. If you're more than 3 to 5 years away from retirement, why would you ever own something that has a 2.3% annualized return? It makes zero sense, and it's actually one of the riskiest things you can do as a long-term investor because inflation tends to be 1 to 3% or more, and if you're earning less than 2% a year, you're not even beating inflation. Next, we're going to cover three Vanguard funds that are popular in this three-fund strategy. And then I'm going to show you something at the end that if investors would have just owned this one fund, they'd be far better off over the last 10 years. First up, we have the Vanguard Total Stock Market ETF, VTI. Now, this by itself is probably just fine for anybody to own, but when you match it with this international fund and the bond fund, that's where it becomes toxic for anybody that's under 40 years old or 50 years old and still has more than 5 or 10 years to invest. Our total market index provides a diversified and low turnover portfolio spanning the entirety of investable U.S. equity market for a rock bottom fee. So that's what you're getting, a diversified investment in the U.S. stock market. If we look at the performance, we can see year to date it's down 20%, but over the last 3 years it's up on average 9%. Over the last 10 years it's up on average 12%. And over the last 15 years, it has averaged about 8.39%. That's a nice return over 15 years. Okay, next we're talking about the Vanguard Total International Stock ETF, VXUS. And I have a problem with this one too. The global economy is so dependent on the United States that if anything happens to the United States that's detrimental, anything from inflation to war to risks to administration changes, any of that stuff, it is going to dominate and hurt the rest of international markets, no matter what. It's unavoidable. And so by investing in international funds, you are taking on the risk of something bad happening in the US, but you're also taking on the risk of something bad happening in all of these international markets. And as you'll see, this thing has just trailed the US market horribly over the last 5, 10, 15, and even 20 years. And so for me personally, I don't want any exposure to international stocks. And sure, past performance isn't predictive of future returns, but trends are trends. And until I start to see improvement in international markets versus the US, I have no reason to go outside of the US when the global markets are so interdependent and intertwined anyways. So the fund tracks the FTSE Global All Cap Index, which includes stocks of all sizes from foreign, developed, and emerging markets. It's weighted by market cap and it excludes everything from the US. Year to date, it's down 25%, more than the VTI year to date. And what you'll find is over the last 3, 5, 10, it doesn't even have 15 years, but if it had 15 years, it would be worse too. You can see the index that it tracks is only 0.74%. But over the last 3 years, it's down 1.5%. Over the last 5 years, it's down 0.68%. Over the last 10 years, it's only up 3.47% per year. And if you look at every individual year, it is almost never done as well as something like the VTI or VOO anyways. So why own this fund when you are essentially diversifying your portfolio and taking on all the risks of the US market anyways? And then the bond fund, right? There's, in my opinion, no reason for anybody that has at least 5 years away from retirement. I mean, if you want to be conservative, 10 years from retirement, we don't need bond exposure at all, and I'm not going to have any. Bonds are supposed to protect you during volatile times. They're supposed to protect you from inflation and risk-adjusted returns and all that stuff, and they just haven't worked the way that they were supposed to and designed for a three-fund portfolio. Year to date, this bond fund is down 16%. Over the last 3 years, it's down 4%. Over the last 5 years, it's negative. And then over 15 years, it's up 2.41% per year, which hardly beats inflation, and it might not even beat inflation over the long term. So, in my opinion, no reason for long-term investors with more than 10 years from retirement to own any bonds whatsoever. This is going to shock you and it's going to make a lot of people mad, but I would rather own this fund and this fund alone than a combination of all three of these. I'm going to tell you about QQQ and what it gets invested in, and then we're going to go through a scenario of dollar cost averaging into QQQ over the last 10 years compared to dollar cost averaging into a 60-40 stock to bond portfolio using VTI, VXUS, and BND. And QQQ just crushes them even with the volatility and even with the drop year to date. Okay, Morningstar hates this ETF. Illogical index construction overshadows tremendous performance. Invesco QQQ has turned in exceptional performance over the last 15 years. That's a pretty long period of time, but its NASDAQ only focus arbitrarily restricts its opportunity set and breeds sector concentration. It retains its Morningstar analyst rating of neutral. The benchmark plucks the 100 largest non-financial firms listed in the NASDAQ and weighs them by market cap. It automatically excludes stocks listed elsewhere, which shrinks the fund's opportunity set for no economic reason. Some of the large cap market's best recent performers like AbbVie, Eli Lilly, are excluded because of their New York Stock Exchange listings, and should one of the fund's marquee holdings move from the NASDAQ, the fund would have no choice but to sell it. Year to date, down 29%, so about 9% more than VTI, which if you think about it, that's not that much. I mean, it's 9%, right? But if you look at the 3-year, 5-year, 10-year, and 15-year returns, they still, even with this drop, outperforming VTI and definitely crushing this 3-fund portfolio. Over the last 3 years, it's up 13.5% per year, even with this 29% drop. 5 years, up 14.29%. 6 years, up 16.75% on average. And 15 years, up 12.55% on average. Now I've used Y charts to build this scenario that compares this Vanguard, its 60-40 or the 3-fund portfolio versus the QQQ versus the benchmark, which is the S&P 500. Am I recommending anybody just buys the QQQ and QQQ only? No, talk to your financial advisor. I'm not a financial advisor. Make your own decisions. But this is just to show you not to follow this conventional safe investment advice without doing your own research and actually thinking critically for yourself. The ultra safe retirement, make your retirement safe Vanguard 60-40 3-fund portfolio is down 20% year to date. We talked about it. That is better than the QQQ year to date, but it's actually worse than just the simple S&P 500, 19% year to date. Then if you go 1 year, 3 year, 5 years, and 10 years, it's just horrible. We'll just focus on 5 and 10, a little bit longer time frame. 60-40 is up 5.2% per year. QQQ is up 14.29% per year, and the S&P 500 is up 10%. And then over 10 years, 7% for the 3-fund portfolio, 16.75 for QQQ, and 12.59 for the S&P 500. Let's look at the top 10 underlying holdings if you were to own this 3-fund portfolio versus the QQQ. The top 5 holdings are all the same. The difference is the weighting of the companies, right? So you've got Apple, Microsoft, Amazon, Tesla, and Google, right? In the QQQ, Apple's 13.7%, Microsoft is 10%, Amazon's 7%, Tesla's 3.8%, and Google's really about 7% because these both represent Google. Then in the QQQ, you also get exposure to Meta, to Nvidia, to Pepsi, and to Costco. In this 60-40 portfolio, you get United Health, Berkshire, J&J, and Exxon. So I have no issues with these top companies, but the problem is there's not a lot of the portfolio in total that is actually aggregated to these top companies. And these are some of the best companies in my opinion, even though the ones over here, so Microsoft, Amazon, Tesla, Google, they're all down a lot. Meta's down a lot. Nvidia's down a lot. Even though they're down, I still think they're great companies. And the fact that they are down this much means I think now is actually the time to be considering the QQQ versus something like a more conservative approach, especially when that conservative approach loses 20% or more anyways. And so finally, I've just built a 10-year scenario using Y charts again of dollar cost averages, starting with a $10,000 investment and then dollar cost averaging $1,000 every month over the last 10 years into this 3-fund portfolio and into the QQQ. In total, dollar cost averaging over the last 10 years, the contributions would have been $130,000. $10,000 to start and then $1,000 a month for 10 years, $130,000. The QQQ dollar cost averaging would be worth $300,000 right now. The 3-fund portfolio would be worth $166,000 over the last 10 years. It has only gained $30,000 over the last 10 years. That is not how you make your way to retirement.